You're listening to The Pilot's Portfolio, formerly called the Pilot Money Podcast. To learn more about the name change, join us in Season 2.
You can make a lot more money on the hot stock or a lot more money in crypto, but you can also lose that money really quickly. And in real estate, it's just a slow, steady game. But if you stay the course and you really learn, it's just incredibly accretive. And there's so many tax benefits that go along with it.
You're listening to the Pilot Money Podcast, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot Money Podcast takes off now.
Well, welcome back, folks, to another episode of the Pilot Money Podcast. Today's episode is going to be chock-packed. We're going to talk about so many things. But before we get into that, I want to share some things with you because I come to you feeling really full right now. So this past week, I got the opportunity to volunteer with OBAP's ACE Academy here in Charlotte. And I look forward to doing it every single year. And what this entails is that we spend about a week with students aged from 13 to 17 years old. And we get to introduce them to everything that aviation has to offer. And particularly here in Charlotte, that's a really robust and rich experience. You know, obviously the big player on the field here at Charlotte Douglas International is American Airlines. And then of course you've got the wholly owns as well, PSA and Piedmont. And then our business aviation community is also really rich and robust. And this year, we had Lowe's open their hangar and their facilities. We also had Duke Energy allow the kids to come and look at the jets and also the helicopters. In years past, we had Da Vinci jets. So we're thinking about private aviation there. So we had commercial aviation. We had business aviation, private. ATC that was really fun. The kids got to do a tower tour. The new tower here in Charlotte is the second tallest in the country, second to our neighbors to the west and Atlanta. So coming in at 370 feet tall there. So they got to go up to the top and then also spent some time in Tracon. Back at American Airlines, they got to see the heavy maintenance hangar, talk to business leaders, see airport operations, you name it. They even got to fly the A320 in the sim without the motion turned on. So that was just a really neat experience this past week, just to watch the students as their horizons were just really expanded in aviation and to really see just all the participants in terms of the businesses that wanted to participate in this. So that was pretty cool. I'd love to hear, how are you sharing your love with aviation with the next generation, right? I'd love to hear that. Are you connected with volunteer organizations? Is it more of a grassroots thing? Love to hear that. So send an email, pilotmoneypodcast@ceterainvestors.com. Send pictures. We'll post those on the socials as well. In this week's camp, it did culminate with a flight. So we partnered with the EAA. So probably most of the kids got their first flight in a single engine piston airplane. So that was pretty cool. And I think personally, I had like a full circle moment this week. So a couple of years ago, I was at the airport overlook with my family. We were watching planes take off and land. And I saw a young man and he was taking pictures of jets. And so I approached him. I said, hey, it looks like you're really interested in aviation. And we struck up a conversation. And I said, hey, well, I'm involved with this camp and here's the information, wrote it down, gave it to his mom and everything else. And so on the first day of the academy last week, she approached me and I'd forgotten all about this. And she's like, hey, I met you 2 years ago. You introduced my son to this and boom, now he's here. That was really neat because we had about 80 students apply and we had space for about 20. So that was pretty cool. But, this is the Pilot Money Podcast. So I appreciate you indulging me and letting me share that experience with you. But of course, you followed along and you signed up. You wanted to hear things that are pertinent to your financial planning and your personal finance. And of course, for those that are just joining, my name is Timothy P. Pope, a certified financial planner specializing in the planning needs of the professional pilot. So this podcast is the place where professional pilots come to hear the unique challenges and opportunities in your industry and how that relates to your financial planning. So one thing I do want to mention is, folks, we've been seeing the hiring pauses from the major airlines coming out, and they're saying, look, they're going to pause hiring until the beginning of next year. We're seeing the same come from some regional airlines. I believe Piedmont has paused hiring and rescinded some CJOs. Okay, so not good news, not happy news for those CJO holders and also the hopefuls that were looking to start their careers at Piedmont. We've also seen some furlough notices as well. And so how this relates to your financial planning is this is a really good time for you to check your emergency fund. Okay, if you were a recent hire at a major airline or a recent hire at a regional airline, check your emergency fund, because that emergency fund is if you get a notice. That's like your altitude, right? You're going to change that altitude for airspeed, and that's going to tell you how much time you have until you're really going to feel a pinch. So the way I want you to evaluate your emergency fund is take a look and see what your non-discretionary expenses are. So I'm going to call them iHug, your iHug money, like iPhone, so iHug. And that stands for insurance premiums, your housing cost, your utilities, and groceries. Probably should be iThug money, because we need to think about transportation costs. But I just couldn't get excited about saying iThug. So you got to figure out, just don't forget your transportation costs. Let me know what acronym you come up with there. So anyways, look at your non-discretionary expenses, figure out how much money you have in your emergency fund. So if you are to get a furlough notice, if your airline rescinds a CJO offer that you were looking forward to, how long is it going to take you to pivot? That's going to take a lot of stress off if you find that it's adequately funded. If it's not adequately funded and you have income now, make sure it's adequately funded, and then you can go from there. So that's enough about current news, the hiring pauses and furlough notices. In today's conversation, we have a fantastic conversation. This one will not disappoint. From the feedback that I've been hearing from you, the folks that we work with, our clients, they're also interested in this topic. So today's guest is a major airline captain, a real estate investor, the CEO of real estate private equity firm Turbine Capital, and also the host of the Passive Income Pilots. So we've got Tait Duryea on today's program. And listen, when you listen to today's conversation, you'll notice that Tait is a teacher at heart who is very passionate about the real estate investing. And it's awesome. And he shares how he got started in real estate investing, which again, a lot of you have asked, like, hey, how, Tim, we want to know how people who have walked in our shoes, how they got started. So Tait breaks that down. He just reveals everything, how he got started. He's also going to share how his strategies have evolved over time. And I want you to think about that. How is your personal investing, your personal finance expected to change over time? And then, he explains why he believes investing in real estate is completely different than any other asset class, and how he encourages investors to educate themselves. So with that, I do appreciate you hanging out for a longer than usual intro. So let's get to today's conversation. Well, Tait Duryea, welcome to the Pilot Money Podcast.
Hey, Tim, thanks so much for having me on.
Absolutely. I'm excited to have you here. So for those who don't know, or maybe hearing you for the first time, I'd love for you to share with us a little bit about your aviation background.
Yeah, thanks. So I'm an airline pilot and an entrepreneur, but first and foremost, an aviator. And I started flying when I was a little kid. My two uncles are both airline pilots. My grandfather was actually a pilot, so I'm third generation at Hawaiian Airlines. Pretty cool. My grandfather started there in the 1940s in an amphibian Sikorsky S-38. He retired back in the 70s. My two uncles were always mentors to me growing up, and just started flying airplanes when I was about 11 years old. Always knew I wanted to do that. I almost went to business school. I really wanted to go to USC and study business and entrepreneurship, and particularly real estate, but I didn't get in. And I tried really hard and I didn't get in. And so my backup plan in college was flying. And boy, what a good backup plan that ended up being. Got my CFI at 18 years old, instructed all through college, flew some cargo, came out of college in the Great Recession in 2008, but managed to land a job flying caravans out in Albuquerque, New Mexico. Went from there to flying Metros, which is, for anybody that doesn't know, a 19-seat twin turboprop. That was on a Navy contract in San Diego. where I had lived previously, which was fantastic. So I was flying 5 days a week for the Navy out of Coronado. And in any case, got my hours there, somehow, some way, skipped the regional airlines and ended up at Hawaiian Airlines in 2010 at the ripe old age of 23 years old into a 767, which was pretty incredible.
Man, I love that. So you've done a lot of different flying.
Yeah.
Which is super cool. You also were very interested in entrepreneurship and real estate. And while you didn't go perhaps the formal route through B school or business school, you have still managed to do it. We'll talk about that. I love that story.
Thanks.
As a pilot at Hawaiian, I've got to ask, what's happening with the Hawaiian and Alaskan merger? What could you tell us? What's the sentiment in the flight deck right now?
Yeah, I think it's pretty positive. I got to say, when I woke up to that news, it was a shock. That hit.
I think I texted you
hard.
The day after.
You did. You did. You asked if I would be willing to come on and talk about it. I was still saying that I wasn't at that time because it was emotional.
Yeah.
This is a very tight-knit pilot group at Hawaiian. The culture is incredible. We only have just over 1,000 pilots. It's a very tight-knit group, and we have a lot of pride in the brand and the family that we are as an airline. And it was difficult waking up to that news. I think a lot of people felt betrayed. Obviously they couldn't share any information about this ahead of time because they're two publicly traded companies. It had to be a surprise for everyone, which is understandable. But also understandably, I think a lot of the employees were put on their heels and felt like the rug had been ripped out from them a little bit, and we were disappointed in management that while Delta and United are having their most profitable quarters in their history of the airline, that we're still losing money and that the ship wasn't being steered in the correct direction. Dunkerley, the previous CEO, really put us on a course to growth and success. While he was hard on labor, we had to fight really hard for our contract back in 2017. He did really great things for the airline. He really had vision. The current management, I don't think most people would say that they are really behind the current management, and there hasn't been a very clear vision post-pandemic. So it was a little tough in the beginning, but hey, it's better than a bankruptcy. And I think at the end of the day, it's going to be better for everyone, and it's going to give people more options. The fact that we only had a Honolulu base for, the last 90 years, and now folks are going to actually be able to go and live somewhere on the mainland later in their career, if that's something they want to do, which is certainly something I might be interested in later in my career. I got to say, I never wanted to fly a 737, but, and that was one of the things that was like, I didn't sign up to fly 737s domestically, but hey, it's part of the process. And, I think Alaska really wanted to bring the expertise of wide-body international flying in-house. It was easier to buy that than it was to grow it in-house. It takes many, many years to onboard a wide-body fleet. And so if they could just roll that expertise right in, I think that they want to base wide bodies off the West Coast, go kind of toe-to-toe with Delta. They own the Hawaiian brand, or they will, unlike Virgin, where they didn't own the brand and they were leasing the rights to use the Virgin name. They will own the Hawaiian name. And so the goal is to operate it as two separate brands within one company. So I think it'll be good for everyone. We're going back to the negotiating table if this goes through. We just signed a contract that went into effect 14 months ago. It was a good contract. And so the opportunity to reopen Section 6 again and go for a JCBA early is fantastic. So hopefully before we see any big economic slowdown. So yeah, I think overall people are optimistic about it now. I think it's going to open up some opportunities. It'll be good financially. So we're positive about it.
Well, that's great to hear that the sentiment has turned. I mean, with any huge change,
of course,
right? There's that shock factor, and then you evaluate the information at hand, and then you say, hey, this may not be as bad. So thanks for that update. Now, the real reason we've got you on the show, man, is because, yes, you are a professional pilot. You fly for a major airline, very experienced in all those things, but you also do some other stuff. Tell us about that other stuff. What do you have going on?
Thanks, Tim. Well, I'm just like you in the pilots helping pilots business. I started investing in real estate in 2012, really was the first time that I could, because back, for anybody listening to this that has gotten into aviation in the last 5 years, this will be I used to walk to school uphill both ways, barefoot story, right? But
Right,
we
yeah,
didn't get
yeah.
paid any money, I was flying that
Yeah.
Caravan and the Metroliner. I think I was taking home, $800 every 2 weeks. And so it was like, I always wanted to be investing in real estate, but it wasn't possible back then. I bought my first house in 2012. It was in Vegas. And that was my first rental property. And I did not have any interest in owning a primary residence. I wanted to buy rentals.
Okay.
So I tracked down this 3-bedroom house in Summerlin, bought it. I was 25 years old. And I remember this was pre-Uber. I got off of a red eye and I took a taxi out to it and I stood in front of this thing and the doors were open. The movers were moving the old owners out and the landscapers were there cutting the grass, and my stomach just sank. I went like, what have I done? I've ruined myself financially. There's no way I can handle this. But that turned out to be just an incredible investment. And that was my foray into being a real estate investor. I've invested very heavily in real estate for the last 12, 13 years. And it's always been a passion of mine because I love how tangible it is. It's a get rich slow, but it's a get rich for sure game. 90% of all millionaires, there's that Carnegie quote, right? 90% of all millionaires become so through ownership of real estate. And it's so true because real estate is something that it's tried and true. It's got a 200-year track record to back it up. I mean, more than that if you look back. If you're careful with it and you know what to do, there is no other asset class that can make you as much money in the long term with as little risk. You can make a lot more money on the hot stock or a lot more money in crypto, but you can also lose that money really quickly.
Sure.
And in real estate, it's just a slow, steady game. But if you stay the course and you really learn, it's just incredibly accretive. And there's so many tax benefits that go along with it. So that's something we can get into later.
So you buy this property. It's in Vegas. Where are you living in 2012?
I was living in Hawaii.
Okay.
The long distance real estate. Yep. So I hired a property manager and really I could have managed it myself, but the technology wasn't as good back then as it is today. Today you've got all this software, Zillow Rental Manager, and all these incredible apps that you can manage a property from multiple states away fairly easily. I didn't have that. And I also wanted to put an arm's length between me and the family that was renting it because I didn't want them to know that I was 25 years old.
Sure. Fair. Very fair.
Yeah, put a tenant in there, had the property manager. Property appreciated quite quickly. And I ended up selling it because I looked at my return on equity and I thought to myself, okay, I've got all this equity and it's only earning me X amount of cash flow. So if it's okay, I want to break down the 4 ways that real estate make money real quick in 4 ways. Cash flow, which is obvious, appreciation, depreciation, which is the tax benefit, and we can bust that apart, and amortization, which is the gradual pay down of the loan. So let's unpack each one of those. Cash flow is obvious. You buy a property, it cash flows $100 a month. That's your cash flow, right? Money in, money out. I like to say thrust versus drag, right? Your income on a property is your thrust. Your drag is all of your expenses. And when you're left over, hopefully you have a surplus of income, right? And if you don't, hopefully you have some altitude that you can glide. And that altitude is cash reserves.
That's right.
So if you're negative $100, $200 a month, you better have cash reserves or altitude in the bank to fund that. So that's the cash flow. The appreciation portion is fairly obvious. Real estate goes up over time. Now, one of the important things to note is that when you're looking at appreciation in any asset, whether you're talking about a stock, a real estate asset, a piece of gold, is it going up in value or is it staying the same and the dollar is becoming less? If inflation is running at 5% and your property appreciates by 5%, did it really appreciate by 5% or did the dollar lose 5% of its value?
Correct.
The great thing about real estate is that it's an inflation hedge. So getting out of the dollar and into bricks and sticks is a great move, right? So that's the appreciation piece. Let's leave depreciation for last. Let's talk about amortization. So one of the wonderful things, the best thing about real estate is the fact that you can leverage it. So you only need 20% down, sometimes even 10. You can even get into a property for 3.5% down or 0% through some of the VA stuff.
And when we say leverage, we're talking about taking a loan out, like a mortgage out.
Correct. Exactly. So leveraging meaning your down payment is 20% and the bank is going to finance the other 80%. Now, 99% of the time, when people say I lost money in real estate, it's because of debt. Because debt is going to be your largest piece of drag, right? That's your largest expense. So if you lose your thrust and you're unable to service the debt, the bank, your house, the property, whatever it is, that's collateral, right? So they have the ability to take that back to make themselves whole because the bank doesn't get to participate in any of your upside, right?
That's right.
So they just want their percentage and they need to have some safety because they don't get the upside. They want to have the safety of the collateral of the asset. But if you put 20% down on a property and it doubles in value over the next, say, 10 years and you sell it. So let's say you buy $1 million property. You put $200,000 down and it increases in values to $2 million over 10, 15 years. Well, simple math would say you doubled your money, right? $1 million, sell it for $2 million. Well, because of the leverage, you've actually 10x'd your money. And that's the power of leverage in real estate is you have gone from putting $200,000 of your own money in and now it's gone up in value to $2 million. And that is, of course, if you've amortized and paid down the loan over that time to zero. And that's the wonderful thing as well is imagine buying Microsoft for 20% of its value, renting it to someone else for 30 years, and then owning it outright.
Yep.
There's no way, right? So anyway, amortization is a wonderful thing. It's the slow pay down of that debt over time. And then lastly would be depreciation. So we get to take a tax deduction against an asset that is increasing in value. Let me ask you, why would the IRS let you take depreciation against an asset that's increasing in value? Because usually you buy let's say you buy a printer for your business, right? It's worth $100. Over 5 years, it loses value and it's now worth zero. You get to write that off over time. So that makes sense. But if with a house, how come the IRS lets you write that off? It's increasing in value, right? It doesn't make sense initially.
It's to encourage investment is why they allow it.
Precisely, because the IRS wants to, as you know, Tim, the tax code isn't written just to collect dollars. It's to incentivize certain activities. And real estate ownership is good for us as a country. You look at any housing in a communist country, and you can tell that the government is not very schooled up on inspired housing solutions, right? So they would rather incentivize it and put it with the private sector. The other reason is that bricks and sticks, they do break down over time. So your refrigerator isn't going to last 27 and a half years, which is the full depreciation schedule for a residential property, right? Your carpet isn't going to last 27 years. The IRS knows that. So they let you take certain items faster. We can talk about that. That's getting into the weeds on segregation studies and bonus depreciation, accelerated depreciation on certain aspects. But things do break down, wear out over time. And so they let you take that depreciation. So those are the 4 ways that real estate make money. And that's why I love it so much. That's why it's my favorite way to invest.
So you started in 2012. You did a long distance rental. You said family. So I'm thinking that it was a long-term rental as well. It wasn't a short-term.
Correct.
But over the past, 12, 13 years, you've been investing heavily in real estate. I imagine your portfolio has been expanding. Your activities have been expanding. What'd you do next? How has this thing evolved?
Yeah. So I continued buying some single family, did a 1031 exchange into some multifamily on the East Coast. And about that time, this was about 7 years ago, I started attending real estate investing conferences, which if you're looking to get into real estate in a big way, conference is just incredible.
You said you did a 1031 exchange. So
yes.
Your house had appreciated a lot in value.
Correct.
What did that 1031 exchange allow you to do?
So if I was to just sell that property, and let's say I had a $500,000 gain, it's not my primary residence, I would have to pay long-term capital gains tax on that gain. A 1031 exchange allows you to roll any amount.
And depreciation recapture.
Correct. And the depreciation recapture. So all those tax benefits that I said you get, yeah, you got to go with those back to Uncle Sam. Exactly. Because they say, okay, we gave you that tax benefit in the short term. Congratulations. I hope you enjoyed those. But now you're selling that, let's use that printer, for example, right? If you wrote it down to zero and then you sold it for $200, they go, oh, well, you didn't actually lose money on this, did you? Okay, give that back. But if you do a 1031 exchange, you're rolling those gains into the next property. And this is one of the most powerful tools in a real estate investor's tool belt, is they can take that, say $500,000, million.
Uninterrupted compounding.
Yes, uninterrupted compounding. Perfect. You can move that into a separate property. And we could do a whole 20-minute podcast episode on all the details around a 1031 exchange, but you can roll that gain into another property and not pay capital gains tax on it. You're not getting out of paying the tax, but you're deferring it. And you can get out of the tax by dying. So that's an estate planning tool that a lot of wealthy families use is they'll 1031 exchange, and they might have tens of millions of dollars of gains that they build up throughout their lifetime. And when they pass away, the next generation inherits those assets. The next generation gets the step up in basis, and they never have to pay that capital gains tax. It just disappears. Powerful from an estate planning perspective.
So you 1031, now we're in South Carolina.
Yes. So I bought some multifamily in South Carolina, went to this conference, and the goal was to expand my network. The goal was to start rubbing shoulders with more lenders and brokers and property managers and other real estate investors and build my network because I wanted to build up to 100, 200 unit apartment complexes that I personally owned. Well, something different happened. I met the airline pilots of real estate, and I realized that at the end of the day, I was a doctor flying a Bonanza on the weekend. And I was like, okay, so wait a minute, let me get this straight. You have 100-person team and all you do is multifamily, or all you do is self-storage, or all you do is mobile home parks. You've been in the business for 15, 20 years. You know all the brokers, you know all the lenders, and you are just a sniper on this stuff. The self-storage syndication team, this is to back up a second, these are our syndicators. So these are our groups that raise money from private investors and big mobile home parks, multifamily, self-storage portfolios, and split the profits with the investors somewhere in the neighborhood of 70, 30, 80, 20, where investors are keeping 70 to 80% of the profits for doing none of the work. And I'm like, okay, so I can give you 50 grand, 100 grand, whatever it is, and I do none of the work. It's professionally managed. You're getting better deals than I could ever hope to, because any multifamily deal that I'm looking at in, say, South Carolina has already been picked over by, an operator like you. I don't stand a chance. It was like, if you can't beat them, join them moment, where I'm like, hey, this self-storage syndication team that I was speaking with, they had a 6-person acquisitions team. All their acquisitions team did was take brokers to lunch, cold call sellers, and make offers on properties. They'd underwrite and offer on like 1,200 deals a year. I'm like, I can't compete with that. So why don't you just take my money? And so I started heavily investing in syndications. And this was a complete left-hand turn, 90-degree left-hand turn, because my goal was always to build a personal physical real estate portfolio. Since then, I've invested in over 20 syndication deals. They are fantastic. It's my favorite way to invest. I have had a few that haven't performed all that well, but the vast majority have gone very well, have made in the mid 40% annualized on a number of them. And it's completely hands-off. So it's very scalable. For somebody who has a W-2 job, it's a wonderful way to invest because you can scale your real estate holdings without scaling your real estate headaches. Because real estate is not like stocks where you can set it and forget about it for 20 years. If you forget about your rental property for 20 years, it's going to be condemned by the city and overrun. So it's an active sport, right? And unless you're ready to be active in it, there are some people who are ready for that. And for those people, I always say, fantastic, roll up your sleeves and go do it. But it's not for everyone. And this is a great way to either diversify and continue expanding in addition to your physical real estate holdings, or it's a great way to participate in real estate if you're like, hey, I got 3 kids and I'm flying and there's just no way that I'm going to spend my days off flying to some other city to look at duplexes.
This syndication move for you was an introduction to real passive income because you were no longer managing.
Yeah, real estate passive income is a myth unless you're in syndications, right? Because try buying a rental property and collecting that $200 a month cash flow, right? With no work. It's not passive. But syndication actually does allow it to be passive. And the wonderful thing about a syndication versus a REIT is that the tax benefits flow through to the investor. So if you're getting that big write-off, it's going to flow through to the individual investors. in, say, a REIT, which is great in its own right because it's liquid. You can click a button to buy and sell it, which you can't do in a syndication where your money is locked up for a period of time, usually 3 to 5 years. But those tax benefits flow through.
So let's talk about that, because on the passive side, syndications, you've got some passive tax benefits that flow through. You don't have the real estate headaches. But if you participate actively in real estate, there could also be some tax benefits that flow through. Maybe this is a good time to bring back up that depreciation item that we flowed over earlier.
Yeah. So every airline pilot that I know is trying to figure out a way to reduce their tax bill, right? So let's jump into this. This is one of my favorite parts about real estate. Residential real estate has a depreciation schedule of 27 and a half years. Commercial real estate is 39 years. You might be hearing commercial real estate, that's office buildings, right? No, anything over 4 units is commercial. So if you're looking at multifamily, you can buy a duplex, a triplex, or a quad with a residential loan. But if it's 5 units on a tax parcel, you now are in the commercial realm. Works completely differently. The lending environment is different. You have to get a commercial loan, much more difficult. It's much more difficult to get a small loan in commercial real estate than it is to get a big loan, which is opposite of residential, right? Anything less than a $5 million loan in the commercial real estate space is called a small balance loan. And if it's less than $1 million, it's extremely difficult to get. But anyway, that's neither here nor there. Commercial real estate is depreciated over 39 years. You can't depreciate land. So let's look at a multifamily apartment complex. Tim sees and says, hey, I want to go buy this thing. It's $1 million. Let's say it's 20 units. And let's forget about the fact that the loan is going to be difficult to get. Let's say he buys it in cash or he 100% finances it. It doesn't matter for depreciation. The land is worth $200,000. So there's $800,000 worth of structural value there that's going to be depreciated over 39 years. The cool thing is that the IRS recognizes that there are certain components in that structure that aren't going to last the full 39 or 27 and a half years. Like I mentioned earlier, the carpet, the refrigerator, the roof, the drive aisles, the landscaping, all of those things have value that are likely going to be needing to be replaced earlier than that. So what you can do is something called a cost segregation study, which is a big word for an engineering study that takes those items and it breaks the value of them out of the structure. The IRS actually considers this the correct way to depreciate real estate, even though a lot of people haven't heard of it. There's a lot of companies out there that do it. Costs about $3,000 on a house. I can give you an example of a property we bought last October. We can run through this as a real life example after I sort of explain it. But in your example, $800,000 worth of structure, we could probably pull out in one of these engineering reports somewhere in the neighborhood of $300,000-$400,000 of value into accelerated depreciation categories, into 5, 7, and year buckets. The IRS says, hey, that carpet's only going to last 5 years. That paint's only going to last 7. That drive aisle is only going to last 15. So the engineering firm can place a value on those items, break them out of the 27.5 or 39-year depreciation schedule and put them into 5, 7, and 15-year buckets. That's great because now we have $300,000 worth of that value that is in these accelerated buckets. And so the first year, second year, third year, as we go on, we're going to be pulling much more depreciation loss, phantom loss out of that investment. The great thing is bonus depreciation. Bonus depreciation came around in 2017 through the Tax Cut and Jobs Act. Now, it's not the first time bonus depreciation has been around. It's been around in many forms throughout history, but in this current state, we had 100% bonus depreciation from 2017 to 2022. That means that if you bought that printer that we talked about earlier for $100, 5-year depreciation schedule, you could now take all that $100. Instead of taking $20 every year, you could take $100 depreciation in year one. This is why Gulfstreams were flying off the shelf leading up to the pandemic and post-pandemic, because you could buy a $65 million Gulfstream and write it off in year one. Take a $65 million tax deduction for your business in year one, in 1 year. And those losses, if you don't have the appetite for them, carry forward. Let's get back to the apartment. So let's say the cost segregation study pulls $300,000 worth of value out, right? If you had placed this property into service, Tim, anywhere between 2017 and 2022, you could take 100% bonus depreciation on all of that 300,000 because it's all less than 20-year lifespan. Anything that's less than 20-year lifespan is bonusable. So that whole 300,000 you can take upfront in year one. So let's replay this. You bought $1 million apartment building. Let's say you put 20% down. So you take $200,000 out of your pocket to buy this apartment building. You finance $800,000, and in the first year, you get a $300,000 tax write-off. Now, we'll talk about what you can use that $300,000 against in a minute here, but that was if it was placed in service anywhere between 2017 and 2022. We're now in the phase out of bonus. So last year, it was 80%. This year, it's 60%. Next year, it's 40%, so on until it phases out completely in 2027. That is, unless the Senate signs this bill. The House just passed a bill that brings back 100% depreciation. It applies to real estate, and it's retroactive. So this would be huge for real estate investors that it would bring back 100% bonus depreciation, but it's been signed by the House. It's in the Senate. We have no idea whether it's going to be signed.
When the listener hears you say depreciation, we are talking about a tax write-off. We are talking about a paper loss that we generate from this cost segregation study, and it finds its way on whatever tax form is appropriate for this deal. So this is a tax write-off.
Correct. Exactly. And it's really a phantom loss, right? Because it doesn't mean, Tim lost $300,000, but he has a paper loss now that says this asset we're taking bonus depreciation. We're writing down the value of the structure from $800,000. In year one, we're going to take $300,000 off of that. So it's going to decrease his basis. If he ever goes to sell it later, he's going to have to recapture these losses. But he has these losses right now to offset other income. So let's talk about that for a second. Normally, rental real estate activity is considered a passive activity. And there's something called the passive activity rules that came in the 80s because physicians, in particular, were buying a bunch of rental real estate, writing it off, and using it to offset their W-2 income. So they're making $500,000 a year as physicians, buying a bunch of rental real estate. Let's say they bought that same property. Now they only make $200,000. They're only paying taxes on the $200,000. The IRS said, no. You can't do that. Rental real estate is now considered a passive activity, and passive losses can only offset passive income. So let's say that apartment building generated $30,000 in positive cash flow for you. And that's real money that's flowing into your bank account. Well, you could use that $300K to write that off. Or if you had other passive income that was coming in, that's all usable. Now, what happens if you don't have the appetite for all of it in year one? It just carries forward. So let's say it produces another $30,000 for Tim next year. Well, he just takes all that depreciation that he didn't use this year and he uses more of it next year. So now he's got $30,000 worth of passive tax-free income coming in from that apartment building, right? Which is wonderful. Now, there is a way that you can write it off against your W-2, and that is by becoming a real estate professional. And I won't dive too deep down this rabbit hole because it's a very complex topic, but if you do more than 750 hours a year in real estate-related activities and more hours in real estate than you do in your ordinary job, as a pilot, you should be thinking, gosh, I'm the only high-paid professional that I can think of that would be able to accomplish this, which is true. Physicians that are working 2,000 hours a year, there's no way they can work 2,001 hours also on top of that in real estate. It's completely unattainable. The other way that you can get it is your spouse. If you have a spouse that doesn't work and they can maintain 750 hours a year of legitimate real estate related activities, that could be a real estate agent, managing your rental properties, peripheral things like a loan officer and things don't count. In any case, there's lots of information out there on real estate professional status. What that will do is it will unlock that $300,000 hypothetical loss that Tim had on his apartment building, and he'd be able to use it against his ordinary income. So if you're a pilot paying taxes on that $500,000 a year, you would actually be able to take that $300,000 loss against your $500,000, and now you'd only be paying taxes on $200K. So you can see how powerful that is.
I was just going to say, ordinary income equals W-2 income.
Correct.
Right? A lot of times what we find is that W-2 income, right, it's really hard. There's less flexibility in the tax code for the W-2.
Correct.
I want to ask you, what about active short-term rentals? We think Airbnb, average less than 7 nights stay, that kind of thing.
I'm so glad that you asked that because that's the next thing that I was going to get into. If you're listening to this and you're saying, my spouse works, or there's no way that they're going to agree to start managing all these rental properties and spending, 60 hours, it's not too bad, 60 hours a month, but there's no way that I can possibly do that. It's not happening. Well, there is another loophole that is the short-term rental loophole. And I would venture to bet that it's going to be closed in the next decade, because I think the IRS is going to start catching on to this because a lot of high-income earners are starting to do this. Let's say that instead of that being an apartment building that Tim was buying for $1 million, that it was a house that he was going to Airbnb, or that he was going to run the apartment building as a short-term rental. All of the stays would have to be less than 7 days. So let's transition over and let's say you bought a house and you ran it as an Airbnb. You have to self-manage it, spend at least 100 hours a year managing that property, and the average has to be less than 7 days. If you can check all those boxes, that is not considered a passive activity. That is an active activity. So therefore, the $300,000 loss could be used against your W-2. And here's the great part. You only have to self-manage it for that first year because you want to get all that bonus depreciation out of it, right? And you're trying to apply that against your W-2. So if you buy it this year, you're worth 60% bonus depreciation. You buy it, you do the cost segregation study, you get that nice, juicy year one tax bonus. Well, on January 1st, you could put a long-term tenant in there and put it over with a property manager. And now the subsequent losses, you're still going to get some depreciation because we're not taking the entire value of the structure in year one. We're taking a certain percentage that we can break out in that cost seg. So the rest of it's going to trickle out over time and those will be passive. But the big depreciation that you're getting in that first year can all be offset setting your W-2 income if you run it as a short-term rental that first year.
So we think about putting a down payment, right? Let's say use 20% down. We take the bonus depreciation, we offset the W-2, and then we either flip it to a long-term rental. We get the other appreciation from the property. And then at a later date, we 1031 it. And we continue with the uninterrupted compound returns, right? So that's a powerful story. Sometimes I talk to clients about whether an Airbnb could be appropriate. That can help with the tax bill, either on the passive income side or the active income side. So we talked about appreciation, depreciation, amortization, and then the cash flow piece on how to make money in real estate. So you also have a podcast called The Passive Income Pilots. Tell us what you do there.
I do. Yeah. I started Passive Income Pilots in 2023. This was a couple of years after I started my private equity firm. But really, the missing piece was education. No one was, and kudos to you, Tim, for starting this podcast and educating the pilot group. But, when I started my private equity firm back in early 2020, that was a reaction to rubbing shoulders with all these physician groups at these conferences that had organized education platforms for doctors, organized private equity firms for doctors that could help them understand and get access to excellent real estate opportunities, mostly passively, but then also the education to invest actively if they'd like to. And nothing existed like that for pilots.
You want to know why? Because before that, the income opportunity wasn't as strong for pilots,
That's
right?
true.
So,
however, I was just talking about this the other day. You know that in 1997, a narrow body captain at American Airlines was making a little over $200,000 a year. And if you go to BLS, the Bureau of Labor and Statistics .gov website, they have a great inflation calculator. This is a great tool for anybody that wants to give you that sob story of, I used to walk up both ways to school, right? I only made so much money. Google BLS inflation calculator, and you can run an inflation, the buying power of $200,000 a year in 1997 was just under $400,000 today.
That's a lot of money.
It's a lot of money.
Yeah.
So pilots in the 80s and 90s, we're really only back to where we were. I got this data from one of my uncles. His worst schedule was working 12 days a month, 10 months out of the year. And that was making just over 200K back then, which is just under 400K today. So the income potential was there, I think. I think that syndication is not a new phenomenon, but it's been popularized in the last decade, and it's becoming more of a mainstream way of investing.
You were saying that there was all these resources for doctors, but not for pilots, and that's why you started the passive income bias.
There was no good central location for pilots to go to learn about finance, investing, real estate, advanced lucrative tax strategy. And of course, we pepper in some industry stuff as well. We just had the Delta pilot that chartered the A330 for his retirement flight on. Got his story.
You had them? Oh, okay. I read about him in flying.
It's yet to air.
Okay, cool.
And we brought on, we've got Cliff Averill, who's a Seahawks Super Bowl champion who's investing in real estate. He's coming on. So we really wanted to create a platform, an education platform, and a community for financial education for pilots. So that's what we created with Passive Income Pilots.
That's great. I listen to the show. I send clients to listen to the show. I've been on the show. I love your guest lineup, experts in their field. I get a lot every time I listen. So guys, if you are listening and you haven't checked out Passive Income Pilots, but you are interested in real estate, go listen to it. So talk to us about your private equity firm.
Thanks. Yeah, Turbine Capital. It's a real estate private equity firm. Essentially, we kind of dropped off the conversation, but 7 years ago, I really pivoted into syndications, found my way around those, and saw that pilots needed access to this style of investment. And it's a big, scary world out there. There's thousands of syndicators around the US, and some of them are good. Some of them are really not so good. There was a Wall Street Journal article recently that highlighted, I believe it was Apple's Way equity that has lost a ton of investor money and, is a mess. Granted, real estate, was booming, and, the commercial real estate side was booming and everybody was getting into it. And now commercial real estate values are about 30% off of their peak. And so there's a lot of distress in the market, but, the good operators are just fine and the bad ones are not so fine. So we wanted to create a platform that, while we don't offer any tax, legal, or investment advice, what makes it to our platform has been heavily, heavily vetted by an extensive team that I've been able to assemble over the last 4 years. And we take it very seriously. And we run about 4 to 6 deals per year that folks can participate in if they'd like to. And we actually just wrote a 70-page ebook called Autoflight that answers all the questions on how syndication works and how splits and fees and all that stuff works, how the tax benefits work. We recap a lot of the stuff that we just talked about in terms of depreciation schedules and bonus depreciation. So if you'd like that, it's on our website, turbinecap.com, and it's under the resources tab. It's called Autoflight. You can download it right from there.
And again, syndications is a way for a busy professional to get access to professionally managed real estate investing.
That is the perfect way to sum it up.
Right. So real estate without the headache. And I want to confirm, so the losses that you would get through syndication would be passive losses and would offset passive gains, right? So that necessarily wouldn't be I'm looking for something to help with my W-2 income.
That is correct. If you are someone who is able to get real estate professional status, let's say you're a pilot, your spouse is a realtor, obviously they hit the 750 hours of real estate related activities per year. And you also have a small rental portfolio that you and your spouse spend over 500 hours per year materially participating in your rental portfolio. You are well and truly, legitimately real estate professionals. If you fall into that bucket, you would be able to use syndication losses also against your W-2. But if you do not fall into that bucket, even if you're buying the Airbnbs and doing stuff like that, they would be passive losses. Now, it's not the end of the world. I always encourage people, hey, if you can't offset your W-2, then the next best thing is to start throwing money over the fence and creating passive income, because passive income is very easy to offset. So, passive income is great. It's even better when it's tax-free, and it's very easy to make passive income tax-free. So the way that syndication losses typically work is you're going to get a K-1 at come tax time. So if you were to invest in a deal this year, next year you're going to get a K-1, outlines your pro rata share of the depreciation, the profit and loss on that particular deal. So the way that works is if you were to invest in a deal this year, next year you're going to get a K1. And K1 is a profit and loss statement of your pro rata share of that opportunity. So if it included a bunch of depreciation loss, it would be reflected there.
This has been great. I've absolutely enjoyed this conversation. I want to leave the listeners with a little nugget. Like, you've been doing this for a long time. You've got a lot of experience, right? You've got private equity. You've done the single family home, multi self-storage. You've done it all. What would you tell a professional pilot who's thinking about, let's say, maybe they say, hey, I want to dive into the single family home space. What would you tell them to consider?
Educate yourself. That's the biggest thing. I get questions all the time of, hey, I've got 25 grand. What should I do with it? And I say nothing. Put it in a money market account. Stick it in the S&P. Learn, because there's so much education out there. We talk a lot on our podcast, my ebook, about the tactics and strategies of the ultra wealthy, how to not pay taxes. Because you can't go to your CPA on April 14th and say, fix my tax situation. As we say, you got to change your tax. So it's up to you to learn what activities are going to be rewarded by the IRS. It's up to you to learn these things so that you can have an intelligent conversation with your CPA. And if they don't know what you're talking about, then it's time to change CPAs, obviously. But you need to take responsibility. They don't teach you this stuff in flight school. They don't teach you this stuff in med school. And I'm not a conspiracy theorist, but this is one area where I actually do think the system is a little bit rigged, because for anybody that's seen Caddyshack, well, the world needs ditch diggers too. And not everybody can be an entrepreneur. Not everybody can be a real estate mogul. We need people to make the world turn around. And so it's really up to you to uncover all of that information. But, it's not a secret. There's hundreds of books. There's podcasts. Bigger Pockets is a fantastic way to start. Tim, your podcast right here, the Pilot Money Podcast, Passive Income Pilots, come check out our show. There are books, Rich Dad, Poor Dad, Think and Grow Rich. Advanced Tax Strategy by Amanda Hahn is a fantastic one. So educate yourself and think beyond the 401k. Your 401k is going to be fantastic, but you got to do more.
I love that answer, because I am very fond on our show. It's, hey, crawl before you walk before you run, right? And it's just that first part is education, making sure you have a nice solid foundation for you and your family. And then because all these asset classes and all these opportunities behave differently.
Yes.
You got to understand how it behaves and know what to expect. I think where people get upset, or maybe there's a little bit of buyer's remorse, is I didn't have the proper expectations. So my expectations were not met. Maybe the deal was going exactly the way it's supposed to, but maybe we weren't ready for a little bit less liquidity in this deal, because we're always used to having a bit more liquidity, right? Or, maybe, I didn't know that these were going to be passive losses to offset passive. I thought I was going to be able to do something on W2. And so it's like, go in with eyes wide open there. So
definitely.
One last question. I'm just curious. 2022, we saw the Fed was at work, right? We saw huge interest rate rises. How has that changed the way that you invest in deals now than maybe versus several years ago when we were all enjoying super low rates?
That's a great question. So I don't know if you remember back in 2021, Jerome Powell actually said, we're not even thinking of raising rates. 6 months later, went on the steepest rate hiking cycle that the US has ever seen. So needless to say, caught everybody a little bit by surprise.
Bond portfolios beat their worst year ever because of that, right? So that made a new low. But anyway,
exactly.
Continue.
Coming back to that thrust versus drag, income versus expenses conversations. So in commercial real estate, you can't just pay off a loan anytime you want like you can in residential. If you were to buy a house next year, you put it on a 30-year note, and you decide in a year that you want to sell it and be gone with it, you can do that. You can pay off the loan, and there's no prepayment penalty. It's not how it works in commercial real estate. Commercial real estate has draconian prepay penalties. So if you decided in 2 years, you know what, I want to sell this and I'm out, you would have to pay what's called yield maintenance, which is basically you have to pay all the interest that you were going to pay the bank that they were expecting to get over the next few years in order to get out early. And that'll kill the deal returns. So loans have to be right-sized for the strategy of the commercial real estate deal that you're buying. So if you're planning to get in, get out in 3 years, you don't want to lock into a loan that has a wild prepay penalty if you sell before year 6. So a lot of deals were being done with what's called bridge debt, where you're going in, you're buying a property that needs a lot of renovation and operational improvements, and then you're going to flip it, within 3 to 5 years. And so it didn't make sense back then to get into long-term debt because you wanted the optionality to sell within 18 to 36 months. Well, the problem with that is that a lot of deals were purchased in 2021, 2022. In the post-pandemic, we pumped trillions of dollars into the economy. Everybody's looking to put it somewhere. Real estate is still at 100% bonus depreciation. I mean, it's going nuts, right? And a lot of deals were purchased with floating rate debt that expired in 3 to 5 years, 3 to 5 year bridge debt. Well, at the end of that 3 to 5 years, you got to do the loan has to be repaid in full. So you only have 2 options, refinance or sell. Well, rates went up, drag increased. So all of a sudden, you've got a bunch of commercial real estate that's cash flow negative, and you only have so much altitude with that cash reserves. And this is where a lot of commercial real estate deals are seeing what's called a capital call, where they're going back to investors and saying, we're out of altitude. We're either going to crash or we need to buy more altitude. We need to inject more liquidity into this deal. And that's kind of the kiss of death in syndication. Although, when BlackRock does it, they just call it injecting liquidity. But when a syndicator does it, everybody gets really mad, right? So there's some deals that are in distress because of this, because they were expecting to be able to refinance or sell inside of this 5 years. Well, now valuations are off 30%. It's not a good time to sell. But what it means is that it's a great time to buy. So we are seeing just incredible deals in the multifamily mobile home park self-storage space. So in any case, yeah, the high interest rate environment is certainly making it challenging in the commercial real estate space, particularly for deals that were purchased in 21, 22. That is being exacerbated by a large supply pipeline, meaning that in 21 and 22, there were a lot of apartment starts because we're still 3 million housing units short in the US. We did not build enough in the last decade. Well, a lot of that new apartment supply is coming online. So it's making the problem even worse because there's additional supply, which is a drag on rents. The good news is because rates are so high, now construction starts are down 70% from their peak. So if you can, the term is kind of survive till 25, if you're already, sitting on commercial real estate. And of course, if you're like us and you're in a buying position, you're hoping that rates stay high for long enough that we have the opportunity to buy as much as we want during this wonderful period. So we think that 2025, 2026 into 27 will be a great time to be selling commercial real estate because the supply pipeline right now is really dry, means that the deliveries in 26 into 27, and I know I'm getting a little off topic here, but it all kind of ties into that interest rate piece, right? Where we're going to see interest rates, start to come down. The supply pipeline is dried up. And so therefore, we just see this being a very advantageous point of the market cycle. Obviously, underwriting has to be nice and conservative right now. And, you don't want to rely on rates coming down to make the deal work. But if they do come down, the deals will be even better.
So with that huge interest rate spike, what we saw was stress in the commercial real estate market, but opportunity for folks with a nice cash position to come in and buy.
Absolutely correct.
There's always opportunity. On one side of the deal or the other, there's always opportunity. You just got to be positioned for it.
As Warren Buffett says, right? Be greedy when others are fearful and fearful when others are greedy. It could never ring truer than right now. A lot of people have syndication investors, who invested in bad deals and have had capital calls or lost money. They have recency bias and they're saying, God, I'm never going to do that again. When in fact, the complete opposite is true, right? They're hurting because they invested at the wrong point of the market cycle. And of course, you can never time the market. I'm a big fan of dollar cost averaging real estate, just like you dollar cost average in the stock market. But there's articles flying around online about scrupulous syndicators and people losing money in commercial real estate and the fact that office is bleeding out. And it's like, yeah, that's the time you want to be buying is when those are the headlines.
Yeah, that's exactly right. Well, look, this has been fantastic. This has been a real treat for me to have you on the show to talk shop. And I am sure that our listeners are going to just really enjoy this. Anything that you want to leave the pilot listening at home with?
The one other thing that came to mind in terms of beyond education is fill your bench. Your network is your net worth. You're listening to this podcast. You're likely working with Tim, which is amazing. Have a good CPA, have a good financial advisor. Fill that bench with advisors. You want to be surrounded by people who are smarter than you, myself included. I'm always trying to be the dumbest person in the room, so to speak. And I want to be surrounded by people who really know what they're doing. And a great CPA, a great tax attorney, a great financial advisor, someone who really understands life insurance and can do that piece. So continue listening, continue learning, and link arms with people who know what they're doing.
Love it. So folks, Tait Duryea, captain at Hawaiian Airlines, CEO of the Turbine Capital Group, and host of the Passive Income Pilots. Thanks for coming on.
Thanks so much for having me, Tim. It's a pleasure.
Well, and that brings us to the debrief section. The first thing I want you to think about is the value of time and consistency. And this has implications in your investing, but also more broadly. Here's what I mean. Tait said that real estate is a get rich slow, but a get rich for sure endeavor. And as you know, as a certified financial planner and somebody in the investment and the securities industry, I cannot make such guarantees or representations. However, I think we understand the sentiment, right? The sentiment is that if you stick with your plan over time and you learn, you can expect to be rewarded. And so we have the same sentiment, whether it's for real estate or whether it's for the stock market or business in general. We have that sentiment. And I think Tait further demonstrated this when he shared it in his journey. He says, I started with one single family home. And then after a couple of years, he did a 1031 exchange and it allowed him to get into multiple real estate investments. And then after a little bit more time there, he switched to professional management of his deals. And then he started his own real estate company. And so when you think about the value of time and consistency, you can see that show up in Tait's story. I mean, honestly, as a professional pilot, you can see that show up in your story. You started as a student pilot, and now you got your ATP and you're flying professionally somewhere. And it didn't happen overnight, right? And so I think financial planning is the same. Financial planning isn't all about saying no to a lot of things forever, but it's about having a disciplined approach to maximizing the goals that are most important to you and your family, so you can say yes, like more abundantly to more things than you ever imagined possible, right? And I think that falls under the heading of the value of time and consistency. Craft the plan, stick with it, pivot or update the plan as necessary. Life happens, right? Your life is not a spreadsheet. So you make those updates, but you stick with it and you continue to pursue the goal. The second thing that I want you to think about is that, Tait discussed the 4 ways that real estate makes money, right? So there's the appreciation, which is, I buy something for $1 today and I'm going to sell it for $3 sometime in the future. There's the depreciation. So this is an aspect of our tax code that allows you to take paper losses on an investment. And, those can flow through to tax benefits. A lot of times when folks are thinking about, there's a lot of tax benefits in real estate, they're talking about this depreciation portion. There's amortization, which is your loan is being paid off and it being paid off by somebody else, right? A tenant that you have in there, or whatever arrangement you have, somebody else is paying off the debt there. And so, so you're making money that way. And then there's also the cash flow, which I think everybody understands. The cash flow, I've got a tenant in this property and they're going to pay, X number of dollars per period of time, typically monthly, right? So that's the cash flow. Now, what I want you to think about is that not all real estate investments are created the same. And so you want to know what your goal is out of your real estate investment. You want to know which combination of these 4 forces is really going to show up in your deal. A lot of time with long-term tenants and single family homes, sometimes they're not really cash flow positive, right? And so where the investors are really banging on their money is that appreciation, the depreciation, and the amortization. Maybe the cash flow that comes in on a month-to-month basis is just enough to put into an account to offset any issues with the property that you might have to pay for. So you think about that. Or perhaps you found a part of the country or, where appreciation is not growing by leaps and bounds, but man, oh man, do you have a steady flow of tenants? And so, maybe you can enter the property at a nice price point and there's high on the cash flow, not much on the appreciation. And of course, your depreciation is going to be, standard, what you can take off from a paper loss perspective. So point number 2 is just evaluate what you're looking for out of a real estate investment. And then the 4 ways that Tait talked about: appreciation, depreciation, amortization, and cash flow. What is most important to you and which ones are going to show up in your deal? The last point that I want us to think about in this debrief is to understand what role real estate can play in your portfolio. So Tait discussed the importance of educating yourself, before jumping into a deal. And if you are a regular listener to the show, I'm a big fan of that. Hey, we're going to crawl before we walk before we run, that kind of thing. And we're going to educate ourselves along the way. And that's why you're listening to this show as well. And so I think one of the big things that he mentioned is that as an asset class, real estate is different from marketable securities. And I think that can't be underestimated, right? So marketable securities, we think about stocks and bonds and ETFs and index funds, right? Versus real estate, they're completely different animals. And the reason I bring this up is because you want to learn what the differences are and you want to learn what to expect. I think a lot of times when things go sideways and you have a bad experience with something, it's because you didn't expect for that to happen. And so as you think about their different asset classes, you want to think about their characteristics, right? So marketable securities are typically fairly liquid. It doesn't take a lot to get into them. Real estate is going to be a lot less liquid, right, than a marketable security. It's probably going to take a little bit more to get into a real estate deal. The tax benefits of marketable securities really come from the type of account that you invest in. So you think about, a retirement account. Is it a 401k or an IRA or a Roth? A brokerage account, long-term capital gains. And that also exists on the real estate side. But when you think about the tax benefits for real estate, there can be tax benefits for active participants, right? So that depreciation we just talked about in point 2 can come and offset some active income. A lot of times that's what folks are thinking about. Hey, how can I offset my W-2 income? Well, you want to go in with eyes wide open to make sure, hey, is this something I can expect? Or am I participating passively? And can those losses offset other passive income that I may have? Or did I just sell a property and I need, if I didn't 1031 it, can I move it to another deal that I'm going to pull forward that depreciation is going to offset those gains from a passive perspective? So just know and understand what role real estate can play in your portfolio. And I will say this, that Tait and I, we covered a lot in this episode. It might not be a bad idea to give it another listen, if there are things that you didn't pick up the first time. And if you guys want to hear from Tait again, let me know. Pilot Money Podcast at ceterainvestors.com, or you can jump over to Tait's podcast, Passive Income Pilots, that he co-hosts with Ryan Gibson. And you can learn a lot about real estate investing and other passive income opportunities. So with that, thanks for following along on the Pilot Money Podcast. We'll see you next time.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a Pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's Portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.